I would like to welcome you to Ethical Nonprofit Fundraising, Donor Privacy, Tainted Money, and Other Hot Topics. This is the last session in the DCM Associates webinar series for fall 2021. I am very happy to introduce our speaker today, Gregory Nielsen. Gregory is Managing Director of DCM's Southeast Regional Office. He is also President and CEO of Nielsen Training and Consulting. He's an experienced nonprofit CEO and consultant and is committed to helping leaders and organizations excel. He speaks nationally on nonprofit leadership and governance. Prior to this, he served as CEO of the Center of Nonprofit Excellence, which was focused on expanding the reach of organizations to serve more than 500 nonprofits through consulting and professional development. During this time, he launched Destination Excellence, which was a 6-month leadership development program for nonprofit executives, and Circles of Excellence, a peer-to-peer learning program for nonprofit leaders. Gregory is also a military veteran, having previously served as an officer and attorney in the U.S. Army Judge Advocate General's Corps. He holds a Bachelor's of Arts in Government and International Relations from the University of Notre Dame and a JD from Notre Dame Law School. So, and Gregory was also named a 40 under 40 honoree by Louisville Business First publication. So Gregory, I'll let you take it from here.
Michelle, thank you very much for the generous introduction. Dennis, thank you for the opportunity to present today. It's great to be with you all, talking about ethics in nonprofit fundraising, one of my favorite topics. As Michelle mentioned, I served for a little over a decade as a nonprofit CEO. I've been in the shoes that many of you are in today. I understand how difficult, how challenging nonprofit fundraising is and how difficult it can be. We're going to hopefully address some of the ethical issues that often come up in nonprofit fundraising today. A quick overview of our agenda for the webinar today. We're going to talk about ethical fundraising guidelines for nonprofits. So where do we need to be aware of? What are the guardrails that we need to be aware of as nonprofit leaders? Public disclosure requirements. One of the most frequent questions I get asked as both an attorney and a consultant is, what types of information do we have to make available to the public? What types of information can we as an organization keep private? We're going to talk about the boundaries, the lines of distinction between those two. We're also going to talk about donor privacy after the Americans for Prosperity case. Those of you who may have been following the news over the past year know that donor privacy has been very much in the news. There was a Supreme Court case, Americans for Prosperity, that directly addressed the responsibilities and obligations of nonprofits to either disclose or keep private their donor information. We'll talk about the implications of that really significant Supreme Court case. And then we're going to talk about evaluating gift restrictions, controversial gifts, and other ethical dilemmas. Again, if you followed the news this year, you know that one of the ways that we see nonprofits show up in the news, we see other areas of fundraising show up in the news, is around controversial gifts, restricted gifts, naming, etc. We're going to address those issues in today's webinar. When we get started, so I told you at the outset that fundraising is a difficult job. Nonprofit leadership is a difficult job. I get it. There are two types of jobs, many of which we've had, right? We have all had those got to jobs in our past. I've got to take out the garbage in the morning. I've got to do my dry cleaning and my laundry. Those are got to responsibilities. When we think about nonprofit leadership, this is a get to job. This is a privilege. This is an opportunity to not only be an advocate and a representative for those served by your mission, but also to connect people. And that's really what you are as a fundraiser, as a connector. You're an instigator. You're a relationship builder. You are someone who gets to connect others to a passion in their life that makes a difference for a mission and those that you serve. Being a fundraiser, being a nonprofit executive is not a got-to job. Being a fundraising executive, being a nonprofit leader is a get-to job. It's a privilege, what we have the opportunity to create through philanthropy, through generosity. One of my favorite quotes when it comes to fundraising comes from Darren Walker, who many of you may be familiar with. He's the president and CEO of the Ford Foundation. I was listening to a talk that he gave earlier last year, actually, at this point, and he talked about the need to shift our mindset when it comes to philanthropy, when it comes to fundraising. For many of us, for many years, we've approached fundraising from the perspective of seeking generosity, right? It's the old tin can approach to fundraising. We are trying to beg and ask for money, resources to support our mission. What we need to look at in 2021, 2022, and beyond is shifting our perspective when it comes to philanthropy to a mindset of seeking justice. We're no longer just seeking generosity to support the bottom line of our organization. Rather, we're seeking justice for those that we serve in our mission. And again, that's regardless of the type of organization we're leading. If we're representing an organization that addresses the climate crisis, we are seeking funds for climate justice. If we're leading an organization that is focused on education, we're seeking funds for educational justice. You're the voice, you're the advocate of those that you represent through your mission. Let's take a shift here and let's move into what are some of the fundraising guidelines when it comes to ethics, right? These are the black and white aspects of fundraising ethics. What do we need to look to? We need to look first and foremost to the IRS. All of our nonprofit organizations get our charter, our opportunity to operate in this tax exempt status from the IRS. The IRS has specific guidelines that we'll talk about related to fundraising ethics. State law also often plays into issues of nonprofit fundraising. State FTC acts, consumer protection laws, those are things that we want to be aware of as well. And then external entities. So for many of you, particularly if you're here in the States, and I know we may have some folks that are joining us from Canada as well, but particularly here in the States, we have these external entities such as the Better Business Bureau, which has the Wise Giving Alliance, the Association of Fundraising Professionals, AFP, which publishes a code of ethical standards. So when you think about the ecosystem, what is the landscape of nonprofit fundraising ethics from a legal standpoint? These are the areas that we want to pay attention to: IRS, state law, consumer protection acts, and then external entities such as the Better Business Bureau and the AFP Code of Ethics. We think about our guardrails. So what are if we're thinking about fundraising as moving down the road, moving our organization toward its vision and its mission, what are those guardrails that we need to be aware of? First and foremost, and we get this at the state level, we get this certainly from the IRS as well, any communications with the public. As a nonprofit organization, we're an entity of the public trust. All of our communications must be accurate and honest. We must, to the extent that the law requires, protect confidential information. We must be financially transparent. So what that means, and you'll see this when we get to public disclosure section, is providing transparency as it relates to sources of revenue for our organization, the composition of our board, programs, where do our resources go, what do we spend our money on, and then finally our outcomes. Those are the types of communications that the IRS and state law is holding us to as nonprofit leaders when it comes to financial transparency. And finally, and we'll talk about this in just a minute, is the requirement to comply with charitable solicitation registration requirements. Sometimes these can be about as clear as mud. And so we're going to spend just a few minutes talking about what triggers the need to register in a state if it has a registration requirement. How do you know? How do you manage your charitable solicitation registrations? When it comes to the IRS, as we mentioned a minute ago, the IRS requires that our communications be accurate, truthful, and candid whenever we're soliciting funds from the public. We must have reasonable fundraising costs. Again, this is the IRS, and so they're not providing a whole lot of clarity when it comes to reasonable. But the language used by the IRS is that nonprofit fundraising costs have to be quote unquote reasonable. Information about fundraising costs and practices is publicly available, publicly disclosable, publicly discoverable information that should be provided to donors. And occasionally you might have board members or others who push back on the need to disclose this type of information. If you do have any type of resistance or pushback, what you can say and direct folks to is Schedules G and M of your annual 990 as a nonprofit organization require information to be disclosed about your fundraising expenses, your fundraising revenue, and the activities that you pursued as a nonprofit organization annually in your fundraising. Charitable solicitation is something that I've found is frequently misunderstood, often ambiguous when it comes to nonprofit organizations. There are about 40 US jurisdictions and states around the country that regulate charitable solicitation. They define a solicitation or to solicit broadly as any indirect or direct request for money that comes for a contribution, money or property, on the representation that the contribution will be used for charitable purposes. That's how they define a solicitation. Grant requests count as solicitations. So for those states, and as I said, there's about 40 of them that regulate charitable solicitation, this is how they define solicitation and triggering the need to register in their state as an organization that solicits funds. So where should my organization operate? Let's say that for example, I'm in Louisville, Kentucky. Let's say I'm operating a nonprofit organization based in Kentucky. I should, at minimum, if Kentucky has a charitable solicitation requirement, I should register in the state of incorporation. So where my nonprofit is incorporated. Second, I should register in the state of my primary activity. So let's say I'm a Kentucky organization, but I also operate in Indiana. I also operate in Ohio, in Tennessee. I should register there, wherever I have primary activity for my organization. Then states where I have direct in-person solicitation of gifts. So again, if I am physically going to another state to solicit funds from donors in that state, that often triggers the need to register in that state. And then finally, states where I have indirect solicitation. So let's say I am operating a phone bank. I am doing a mass mailing to other states. We're going to talk about what are some of the guiding principles there, because you don't want to run out and register in 40 different states just because you're doing a phone bank or a mass mailing. How do I know when I have tripped that line, when I have triggered that need to register as a nonprofit organization? This also brings into question, what about online solicitations? Almost all of us have that Donate Now button on our website. Because our website is available to individuals in all 50 states and beyond, does that trigger the need to register within each of the 50 states or 40 states that have those requirements? Many states have adopted what's called the Charleston Principles. This is a loose, non-binding set of guidelines to help nonprofits and regulators determine where registration is required. It's important to realize that it's only been actually codified by a few states and incorporated into law. You see those states listed on the slide there. But many states look to the Charleston Principles as a guideline for nonprofits, provide that as a guideline for nonprofits. So what do the Charleston Principles say? They say that an entity that is physically located within a state and uses the internet to conduct charitable solicitations in that state must register in that state. That makes sense, right? If I am physically located in the state of Kentucky and I'm using the internet to solicit funds in the state of Kentucky, I absolutely must register in the state of Kentucky. Where it gets a little trickier is if I'm not physically within a state, but I'm still have an internet presence. So I still am soliciting online donations, or I'm still putting out emails soliciting funds. The Charleston Principles say that non-internet activities alone are sufficient to trigger registration, right? So if I am physically operating programs again in that state, that triggers registration, right? However, if my only connection with the state is indirect, meaning my only connection with the state is that I have a website that could theoretically solicit funds, or I send out a mass mailing that goes to residents of that state, the only need to register is triggered if my connections with that state are repeated and ongoing or constitute a substantial basis. So for example, if I look at my donor registration, I look at my donor rolls and I see I am getting 60% of my online funds from the state of West Virginia. That may trigger a need for me to go in and register. Again, this is not the black and white section of the presentation, right? This is not the absolutely, if I'm physically located in the state, I have to register. This is kind of the reasonableness test. This is where states are saying, how reasonable is it to require an organization to register in our state? And if they're getting a substantial percentage of their donations in our state, we consider that to be reasonable. So again, not a bright line rule. When we switch over to public disclosure, it gets to be a little less ambiguous for us, right? We have straight, bright line rules. Public information, your Form 1023, the initial application that you sent to the IRS for your tax exemption. That's a publicly disclosable document. If an individual wants to get their hands on that document, that's a public document. Your Form 990, that has to be available to the public for a minimum of 3 years. Right? So if someone wants to go on your website, many agencies like the Better Business Bureau ask that you make your 990 available on the website. There are also obviously third parties that publish organizations 990, but the 990 is a publicly available document. Any financial documents that are required by state law, as well as any unrelated business income tax return, that's a public document. Board meetings, notices, and minutes, to an extent, are public information. When we talk about minutes, minutes are only publicly available if you happen to be subject to what we call state sunshine laws. So many times if you're receiving government funding and you're in a state that has what's called quote unquote sunshine laws, then you are required to make your minutes available. Otherwise, your minutes are not publicly available documents. Private information includes your planning documents. No one is entitled to see your strategic plan. No one is entitled to see your annual fundraising plan. Confidential materials such as personnel files, board member addresses is private information. Your budget, your donor information is also considered private, as well as any minutes that may occur during executive session. So again, we think about that importance of maintaining a transparent organization. So make available to the public what the public is entitled to, but also keep private the information that's important to keep private. Many organizations will have what they call a public reporting and transparency policy. If your organization doesn't have that currently, I encourage you to look into it. It doesn't have to be complex. It doesn't have to be complicated. I put an example up on the screen right there that comes to us from a past organization that I've had dealings with, the Montana Nonprofit Association. They have a public reporting and transparency policy that delineates this is the information that upon request we will make available to the public. This is the information that because of law and because of practice we keep private. So just a good, when we talk about best practices, just a strong leading practice for organizations to have a public reporting and transparency policy. Some of the leading practices for nonprofits as we move more into the fundraising section of today's webinar. Sending timely gift acknowledgements, right? When we think about what costs us donors, why do donors lapse from our organization? The number one reason I hear over and over again is the unacknowledged gift from the organization in the past. I made an organization and they either didn't send me an acknowledgement, or that acknowledgement was so far after the fact that I was somehow offended by that, right? Second leading practice for nonprofits, respecting restrictions on donors' gifts. If I make a gift to your organization and I ask you to restrict it to a specific purpose, it is critically important for you as an organization to respect that purpose or obtain my written permission or consent to change that restricted purpose. Disclosing to the public what the law requires, we just talked about, providing timely reports to foundations and other funding sources as applicable. Many organizations, particularly if you have an active grant writing program, will have responsibilities to deliver reports at periodic intervals back to those philanthropic foundations. And then finally, it is critically important to list donors on your nonprofit website in the manner in which the donor wishes to be acknowledged. This is one of those areas where we don't want to assume, as nonprofit leaders, we don't want to assume that just because Greg made a gift to my organization that I want to be listed on your website prominently or recognized in your annual report, right? Rather, have an organizational policy to address this and have a mechanism when you receive gifts of asking your donors in what manner, if at all, do they want to be recognized. Increasingly, many donors wish to either remain anonymous or to keep their information off your website and out of annual reports. But it's important, as part of building and maintaining that relationship with your donors, to ask them how they wish to be recognized, if at all. Donor privacy is, as I mentioned at the outset, one of the hot topics in nonprofit fundraising right now. It's been in the news all year long. It is critically important to pay attention to for nonprofit leaders, but it's important to go back a bit and realize that anonymous giving has a long philosophical and religious history in this country. I'm speaking in the United States. I recognize we may have a couple of folks on the webinar today from Canada or elsewhere, but anonymous giving has a long philosophical and religious history in this country. It was the Roman philosopher Seneca wrote that anonymous gifts allow a person to avoid both praise and blame for that gift. Christianity, Sermon on the Mount, preaches the virtue of secret giving. In the Quran, we hear that if you disclose your charitable expenditures, they are good, but if you conceal them and give them to the poor, it is better, right? So it's important when we come to this topic of donor privacy, one that has been hotly debated politically, one that has been hotly debated in the courts this year. It's important to recognize the underpinnings of history, philosophy, religion in this country when it comes to the value of anonymous giving. We think about donor privacy, one of the first times this became an issue in the country was the issue of the case of the NAACP versus Alabama, right? The case of NAACP versus Alabama was all about the court or the government trying to require the NAACP to publicly disclose their list of members. NAACP challenged that law on the face of the First Amendment, said that it compromised their ability to maintain a relationship with their donors. It exposed their members, their donors, to potential reprisal and retribution. NAACP won that case, right? That was the first time we saw the court weigh in and say, we are going to affirm the rights of donor privacy in this country. On the flip side, what we hear from state entities, federal government, when they try to restrict donor privacy, when they try to engender more transparency and more disclosure of donor information, the compelling government interest we hear is that there is an interest in assuring that the organizations are legitimately entitled to maintain and retain their tax exemption. This is where we come to continued challenges, right? I recommend that all of my clients, my organizations that I work with, maintain a donor privacy policy. This is best practice, right? You can structure your donor privacy policy in a multitude of different ways. It can be an explicit donor privacy policy, meaning as an organization, we disclose the names of our donors unless you tell us not to, right? So explicit, we don't disclose, or opt out, meaning we're going to put the burden back on our donors, that we plan to disclose unless you opt out and tell us otherwise. Right? So again, multitude of different ways you can structure your donor privacy policy. Donor privacy policy also addresses how and where information is stored. What platforms does it cover? So this covers information that we derive through our website, online giving, or does it also include our social media, for example? How are third-party vendors addressed? So if we have, for example, a third-party vendor that does our CRM, that does our donor database, we're sharing information with them, obviously, because that's where we're putting the information. How do we maintain that confidentiality with our third-party vendors? Challenges to donor privacy, as I mentioned, have come from states asking for information that nonprofits put on their Schedule B of their 990, which many organizations redact, to be provided to the states. That's one lane of challenge that we see to donor privacy. The state of New York has tried to do that. Back in 2006, the Attorney General in the state of New York tried to require nonprofits to no longer be able to redact information on their Schedule B. And then third, and where we saw it in the Supreme Court this past year, was the Americans for Prosperity Foundation case against the Attorney General of California. Fun fact for you, the Attorney General of the state of California, back when this law was first passed that gave rise to the Supreme Court, was none other than current Vice President Kamala Harris. The Americans for Prosperity Foundation case went to the Supreme Court, and it was a challenge to donor privacy. It was an attempt by the state of California to require nonprofits to disclose all of their major donors to the state of California, again, under that interest that the state has a need to require and maintain transparency and integrity among the nonprofit organizations in its state. On July 1st, 2021, the Supreme Court struck down this law as facially unconstitutional. The law, as I said, required that. The Supreme Court took the opportunity to provide a more comprehensive approach to addressing the First Amendment rules applicable to disclosure obligations. In particular, the court said that the government has to have a much more compelling interest if they are going to challenge the First Amendment rights of organizations, particularly as it relates to donor privacy. So again, really important case in 2021 related to donor privacy. A couple of tips for nonprofit organizations as it relates to donor privacy: consider confidentiality agreements with your major donors, right? Many larger organizations, healthcare organizations, universities will enter into confidentiality agreements with their major donors, particularly those who give major gifts. It's important to realize that gifts from a donor advised fund by law are allowed to be anonymous. So nonprofit organizations often receive gifts from donor advised funds where we don't know the source of those funds. Donor privacy policy, if your organization has one, best practice is to make that accessible in your charitable solicitation materials, as well as on your website. Other way to maintain integrity in your fundraising is by having a gift acceptance policy. Gift acceptance policy is good governance. It is a way for your board, in all of the other ways that it does so, to maintain integrity and relationship with the public. It's good donor relations, right? Having a gift acceptance policy that clarifies who are we going to take money from, who will we not take money from, is just a practice of good donor relations and good stewardship. And it's important to realize, and I tell this to nonprofits all the time, a gift acceptance policy is applicable to organizations of all sizes. Sometimes when I'm talking to smaller nonprofits, they'll push back and they'll say, I understand universities have to have a gift acceptance policy, or museums, or larger organizations and institutions. How does this relate to me? In reality, a gift acceptance policy protects organizations of all shapes and sizes. As I said, it defines who do we take money from, who won't we take money from. It helps prevent our organization from accepting gifts that are going to cost us more in the long run, cost us more time, money, reputational harm, preserving donor relationships. It also satisfies IRS Form 990. So when I have a board that pushes back and says, all right, we have a policy manual, but why do we need to add another policy for gift acceptance? I direct them to the 990. Your 990 asks the question specifically, does your organization have a gift acceptance policy in place? Gift acceptance policies, by their very nature, are a balancing act. And often the most important value of the gift acceptance policy is the discussion among board, among fundraising staff, among senior leaders of how are we going to put this policy together. It's a balancing act between attracting donors and protecting the organization, respecting restrictions, but also maintaining the needs of the organization for flexible funding. How do we balance privacy with transparency? What does the future hold, right? These are the types of questions that organizations wrestle with in putting together their gift acceptance policy, right? It's the value of the discussion. It's the value of the debate as you put that policy together. A good gift acceptance policy can expedite the process of securing a gift from a donor. So for example, if my organization has a thorough policy in place and a donor approaches us with a gift that we may not have encountered before, having a policy in place can expedite our review and disposition of that gift. Are we going to accept it? Having that policy and process in place is critically important. A good gift acceptance policy also provides a consistent approach for unusual or unanticipated situations. And then finally, it depersonalizes a situation that could be awkward. For example, let's say we have a donor approach our organization that has some controversial history associated with them, right? We're a little bit worried about what it might mean to accept a gift from this particular donor. Having a policy in place that we can talk to the donor about depersonalizes a situation that could otherwise be extremely awkward. As you go through this process and as you look at your gift acceptance policy, it's important to pay attention to the variety of different types of risk that organizations may be exposed to, right? We're all familiar with, and certainly as a lawyer, I talk about this all the time. We're familiar with legal risk, right? If I accept controversial funds that expose my organization to legal harm, that's a risk that my board certainly wants to make sure that we are managing and mitigating. Right? We're all familiar with legal risk. Financial risk. Is this gift going to somehow cost us more money than it brings benefit to the organization? One classic example is, I've got a piece of land that I would love to donate to your organization. That may be the greatest thing that has ever happened to our organization, or once we analyze that gift, we may determine that that gift is going to cost us more time and effort to manage and dispose of and adequately handle, um, that will that'll exceed the benefit that we get. Reputational risk. What happens if we accept this gift, right? Does it expose us to any additional harm from a reputational standpoint? And then finally, when we look at the donor, when we look at the gift itself, is there a danger of undue influence, either because of the size of the gift or the nature of the gift, that we want to make sure that we take into account in making the decision of whether to accept it or not? Common situations where gift acceptance becomes an issue. The first and the classic one is misalignment of values. Right? What happens if the values of the donor, whether that be a corporation, whether that be a foundation, whether that be an individual, don't align with the values of our organization? The classic example is, let's say that I am an organization that is dedicated to addressing cancer treatment and cancer relief, right? And a large tobacco company wants to come in and make a large gift to my organization. Right there, we have a misalignment of values. I'm not saying there's a right or a wrong way to dispose of that or handle that gift, but it's a misalignment of values that we have to pay attention to, particularly from a reputational harm, potential for reputational harm standpoint. Second common situation that comes up all the time is, what about unmanageable restrictions? I want to come in and make a gift to your organization, but I want to restrict it in such a way that it hamstrings you too much, right? We want to pay attention to what, if any, restrictions exist on the gift. Do we have the time? Do we have the staff capacity? Do we have the interest in managing those restrictions and respecting them? The third common situation is, we just don't need the gift. A lot of us, and particularly if you've spent any time in nonprofit leadership, you have encountered a donor who has approached your organization wanting to make a gift, and inside you're thinking, what am I going to do with this? I just don't need it. Example from my past. My organization had just spent a significant sum of money updating our computer infrastructure. All of our staff members had brand new state-of-the-art laptops. I had a donor approach me 6 months later from a corporation wanting to donate a dozen of their old laptops to our organization. Right? On its face, extremely generous. heart was in the right place. But we were in a situation where those laptops, A, were not needed by our organization, and B, would represent a step backwards in terms of technology. So again, having a gift acceptance policy in place allowed us to talk through the issue with the donor, depersonalize, de-escalate the situation. And again, that's just one example. But manage the situation in a way that preserves relationships. Final common situation where we see gift acceptance become an issue is where there's a conflict of interest. I, as a donor, want to make a gift to your organization, but as a nonprofit leader, there is a direct, tangible benefit to me as an individual that interferes with the spirit and the law related to the charitable donation. It's important to have a process in place to manage those conflict of interest situations such that you don't expose yourself as nonprofit leaders, your organization, your board to liability, and also respects the interests of the donor as well. Common restrictions that we see for nonprofit organizations all the time are things like naming rights. What is the size of a gift in your organization that might give rise to the ability to name something, a building, a room, a piece of furniture? Have you thought through that as an organization? That's the type of thing that can go in your gift acceptance policy, or at least in the discussions that you have as a board. Specific charitable purpose. How do you handle someone who approaches your organization and is willing to give you a gift, but only to purchase a specific piece of equipment, or to purchase a specific piece of furniture, or a specific item, right? Those are types of restrictions. How would you as an organization, and this happens with increasing frequency, handle a situation where a donor wants to make a gift, but is requiring you to hold on to that gift for a reasonable period of time, right? So I am going to donate 100 shares of Apple stock to your nonprofit, but only if you promise to hold on to that Apple stock for the next 10 years. And only if you promise to let me know as the donor if you're ever planning to dispose of or sell that Apple stock. How do you as an organization handle that? Again, those are the issues that are more gray. There's not a black and a white way, a right and a wrong way to handle each of these situations. Rather, the value, as I said, is in having that discussion as a board, as a staff, as an organization ahead of time, so that when presented with the situation, you're ready. You understand, how does our organization handle these types of issues? A couple of more concerning restrictions. So I talked about common restrictions. Where do we start to get a little bit concerned when a donor is putting restrictions on a gift? Donor wants to maintain control of the asset. I'm going to give you a van for your organization, but I want to still be able to use it. I want to still be able to come by and take it out for a spin, right? Donor control over an asset, again, interferes with that charitable intent of the gift. Donor wants to prevent the organization from disposing of the asset. That's concerning. If the donor wants the organization to use the gift in some way to benefit the donor or an associate of the donor. Let's say I own a computer sales company, right? I want to give you a gift of $10,000, but I want you to use that $10,000 to buy $10,000 worth of computers from my company. Again, concerning restriction on a gift. Commercial benefit we talked about. Beware of what I call charity shopping. All of nonprofit leaders that I've worked with, I think it's one of the most amazing things, nonprofit leaders that I coach, your instincts by and large are phenomenal. You have a tremendous radar when it comes to ethics, when it comes to situations that make you uncomfortable. Pay attention to those instincts. Pay attention to your gut feel for a gift. If you feel as though there's something off about this gift, a donor may be charity shopping for a gift, for an organization to take him or her up on a gift. Pay attention to that gut instinct. Pay attention to those instincts. Common questions to ask as an organization when it comes to charitable restrictions. Does this restriction in any way jeopardize the charitable deduction? Meaning, is there something in it for the donor, right, that makes us a little uncomfortable with the fact that this is truly a charitable gift to our organization and that there is no private benefit going back to the donor, right? That's the first question we should ask. Does it jeopardize our charity status, right? From a legal standpoint, are we worried about this gift in any way? Do we know how to account for it? This becomes an issue, particularly when we're talking about things like real estate, things like stock, security, other investment vehicles. Do we know as an organization, are we comfortable with how we're going to account for this gift? And then finally, can we manage with and around the restrictions? That's that cost benefit analysis, right? Is it going to take us too much time and effort to manage this restriction such that it outweighs and overrides the value of the gift to our organization? So just some questions to get you started as an organization. Balance policy and procedure. When we talk about gift acceptance, the policy talks about who will we accept money from, right? What are the types of gifts we won't accept? Procedure talks about mechanically, step by step, what happens when we encounter different types of situations. Draw that distinction between policy and procedure in your organization. As you're drafting gift acceptance policies, this is an area that I work with organizations on. Some of the critical elements of the policy, obviously, we always want to have our mission and purpose in mind and at the outset. When will we use legal counsel? What types of gifts might give rise to legal counsel? And as you see on the flip side, on the right-hand column there, who pays those legal and professional fees? Right? So if someone wants to make a gift of real estate to our organization, we know that's going to include some legal fees to transfer the title, right? Who's going to bear those costs? How are we going to address those fees? Restrictions on gifts. Do we want to form a gift acceptance ad hoc committee as an organization? Do we want to have that? Is there value in that? And again, you just see different types of situations that go into a gift acceptance policy. One of the often overlooked ones is appraisals. If an individual or an entity wants to donate something that needs to be appraised, it's important within the gift acceptance policy itself to address how do we get that gift appraised, who pays for that appraisal, what happens if the appraisal is different than what the donor believes, different than the organization believes. How do we handle those discrepancies? A couple of tips for you as nonprofit leaders. Always know your donor. It's what I call the KYD and the KYA of fundraising. Know your donor. So particularly donors that you may not have a lengthy relationship with, but certainly this applies to any donor. Do a basic Google search, right? When you're evaluating, is there a potential for any legal or financial or reputational harm associated with accepting this gift? One of the first things I recommend organizations do is do a basic Google search on the individual or the entity. Check social media as well. You know, is this an individual who is particularly abrasive or controversial on social media such that we might want to at least be aware of that when deciding if we're going to accept the gift? And as I said earlier, pay attention to instinct. Second KY is KYA. Know your asset. I've seen a lot of organizations get themselves in trouble because they somehow didn't want to offend the donor by doing due diligence about the asset itself that the donor wanted to give them. Whether it's securities, whether it's real estate, whether it's jewelry, whether it's another tangible item, there is absolutely nothing wrong with you as an organization doing basic due diligence about the value of that asset so you know what you're accepting or potentially what you're walking away from. As we wrap up, and I'm going to turn it over to Michelle in just a minute for any questions that have come in through the chat box. So if you have additional questions, I encourage you to post them in the chat box now, and we can discuss them, or save them, and we'll open up the floor in just a few minutes. It's important for organizations, and I talk to boards about this all the time in the context of strategic planning, to understand how do you measure your fundraising effectiveness. If I were to walk into your organization tomorrow and I were to say, how effective are your fundraising efforts? What answer would I get? Is it a feel or a gut instinct? Or are you specifically measuring the value of the efforts that you're putting into fundraising? I respect the work of BoardSource, AFP, and others in this area just to provoke that conversation, provoke that discussion, they put forward 3 different measures that go to an organization's fundraising health, right? And that's really what we're talking about here, is how healthy are our fundraising practices? How healthy are our fundraising efforts as an organization? The 3 measures that they put forward were total fundraising net, dependency quotient, and the cost of fundraising. This is not a math class, so we're not going to go through how to calculate each of these in depth, but just briefly for each of them. When I talk about total fundraising net, what we're talking about is taking the total amount that you raise in any given year, subtracting your total fundraising expenses. You do that anyway as part of your annual 990. That gives rise to your total fundraising net. So what was the value of every dollar spent on fundraising in any given year? That's what we mean when we talk about total fundraising net. The second measure, and this is one of the ones that I love the most, is what I call the dependency quotient. This means how dependent is your organization on gifts from a very small number of donors. Put another way, if 1 or 2 of your major donors were to walk away from your organization, how vulnerable are you as a nonprofit? The way we figure out our dependency quotient is we take the sum of our contributions from our 5 largest donors and divide it by our total organizational expenditures, not just fundraising, total fundraising expenditures. That gives us a quotient, that gives us a percentage that tells us, are we highly dependent on these major donors to our organization, or are our revenue streams more diversified, right? Is our fundraising revenue more diversified? The third measure is, what is the cost of fundraising to our organization? The way we figure out our cost of fundraising is we take our total fundraising expenses and we divide them by our total fundraising net. That tells us how expensive, costly, in terms of monetary value, are our fundraising efforts right now. Do we need to somehow become more efficient? So again, I talk to a lot of boards that say we need to be better at fundraising. We need to be more effective at fundraising. And one of the ways that we push back on that is, let's be specific, right? Where are we struggling as a nonprofit organization when it comes to fundraising? Is it that we're spending too much money? Is it that we're not spending enough money? Is it that our board is not engaged enough? Our volunteer base is not engaged enough in the fundraising efforts of our organization? Or are we simply too dependent on 1 or 2 sources of funding, whether that be government funding, whether that be fee for service, or whether that be philanthropic revenue? Healthy nonprofits have enough money to fund their programs. They have a responsible balance of risk and reward. Those are the 2 critical elements to healthy fundraising, right? We have enough money to fund our programs, and we have a responsible balance of risk and reward. As a board member, and board members have that fiduciary duty to provide oversight and ensure that our fundraising is effective for the organization. These are 2 critical ways to just begin the conversation around how healthy are our fundraising practices and our fundraising efforts. So in summation, and then we're going to open it up to questions, it's important to be vigilant about ethical fundraising guidelines and practices. Disclose what's required, protect what's not, and balance the transparency with privacy. Pay attention. I suspect that in 2022, 2023, and beyond, we're going to continue to hear about donor privacy in the news. We're going to continue to see it in state legislatures. We're going to continue to see it make its way through the courts. Pay attention to donor privacy as an issue. I suspect we're going to hear a lot more about it. Engage in tough conversations as an organization around gift acceptance, and measure your effectiveness and share with your board and other stakeholders. I'm going to go ahead and stop my screen share. Again, I want to thank the DCM team led by Dennis Miller, who I know is on the webinar today, for the opportunity, to be a member of the DCM team. I thoroughly enjoy the opportunity to lead the Southeast Division. We have a lot of fun doing so and really have a lot of strong impact on organizations. If you have further questions or would like to connect with me directly, you see my DCM email address up there on the screen, gregory@dcm-associates.com. You can also find me on social media. I'm highly active on Facebook, LinkedIn, and Twitter. Twitter is @Gregory_Nielsen. With that, Michelle, I am going to turn this over to you. I have stopped my screen share, and let's maybe begin with any questions that have come in via the chat window.
Sure. And thanks so much, Gregory. There was so much information, and I know everyone has a lot to digest. There are two questions that have come in publicly and a couple have come in privately. So we'll go with the public ones first. Rebecca is asking, another NGO gave her organization $1,000, but wanted her organization to pass it along directly to a client in need that met their mission. Do you see any ethical quandaries with that scenario?
That's a situation that comes up frequently. I think we would want to know a little bit more information before we gave a green light to something like that. So let's say we would want to know what is the mission of the two organizations. Are they aligned in some way? There's no tax benefit to the other nonprofit organization, right? So it really is just a gift of funds to benefit an individual. Legally, I'm not seeing an issue, but where you would want to do a deeper factual dive is, are there any reputational issues that may come along with accepting this gift? Does it set a precedent that we may not be comfortable with, that we may not be able to manage if it were to happen on a larger scale?
Okay, there's a second question. Is there a standard for fundraising costs versus net?
There is not a standard. This is an issue that provokes strong feelings on both sides of the issue. I come down on the side of being a strong proponent of nonprofits investing in their fundraising infrastructure and capacity. I am not as a donor, I'm not this way. As a board member, I'm not this way. And as a consultant, I'm not this way. I am not one to look at making sure we keep our fundraising costs as bare bones as possible.
Right.
The 99 cents of every dollar goes to fundraising. I believe fundraising needs to be invested in as any other portion of the organization.
As just my own follow-up, is it a good idea for organizations to look at other similar organizations to see how they're doing as sort of a benchmark? Like if you're a performing arts organization, should you be looking at how other performing arts, or is it a size issue? Should be looking at people in your, other organizations in your budget neighborhood?
I think there's always value in benchmarking, right? Data is a tool. It's one tool, but it's an important tool. So benchmarking is always important. I think there's value in benchmarking organizations of similar size. I think there's also geography is another one that is important to pay attention to. What I do think that we need to do as a nonprofit sector, though, is begin to continue pushing harder on that narrative of keeping costs related to fundraising as low as possible. I think that prevents nonprofit leaders sometimes from being transparent about their investments and their expenses when it comes to fundraising. So part of benchmarking is having access to that information from your peer nonprofits. I think that there has for a long time been a reluctance, particularly if we are an organization that does spend heavily on marketing or does spend heavily on our fundraising infrastructure, to share that information. I think that that's part of the trust and part of the transparency that needs to continue to build within and without the nonprofit sector.
Greg, we have some follow-up information on that pass-through gift. I don't know if you can see the details, but it's a community mental health center, and I guess the sister or the other organization wants the money to go to a single woman pursuing her education, and it feels a little strange. And I'm just wondering about, I'm thinking about what you said about, what's your gut telling you, and maybe you need to honor that.
I see the question from Rebecca. Rebecca, I think there may be value in talking that one through offline, just to get a little bit more detail and a little bit more information. I think your instinct is right. Your instinct is this is a multi-pronged analysis. There's the what's legal, and there's the what are we comfortable with as an organization. The other missing piece that I'm not qualified to address is the accounting piece of it, right? What are the accounting implications for our organization of doing this? That's that's more of a tax and accounting question that I'm simply not qualified to address. But Rebecca, I think if you'd like to, we can certainly talk that through offline.
Greg, what, if any, has been your experience with a donor who has already been recognized, say with their name on a building or a major program, and then later negative behavior, possibly criminal behavior, comes to light? Have you come across this in your work, and what have you seen happen?
I have, and unfortunately, we've all seen it come to fruition in the past year or two in multiple different instances, particularly there, in the New York area. First of all, it underscores the importance of a gift acceptance policy. One of the most important provisions of the gift acceptance policy is when, what are our processes for either returning a gift or removing a name or some sort of recognition? Right? If we have that in our policy, that freedom, that autonomy to do that, that's spelled out at the outset, right? When someone makes a gift and makes a gift for a naming of an entity, they understand that up front. If it's not, my encouragement to organizations is you always have that autonomy and that freedom. Unless there is something legally, such as you've executed a contract with that donor that doesn't address a morality clause, for example, you legally have the best interests of the organization within your autonomy, right? So if you need to do something, yes, there's going to be blowback. There's going to be negative ramifications or repercussions that you'll want to talk through. But the representation and the public trust that you hold with the community, in my view, outweighs the uncomfortableness of having to remove a name from something.
All right, I've got one more question that I think
I'm
will
ready.
just take us to 2:00.
I'm ready.
Is it, or what are the ethics of paying professional fundraisers? Is it ethical to pay a professional fundraiser a percentage of what they raise?
Oh, two important questions, and it's important to separate them. Is it ethical to pay professional fundraisers? Absolutely. Fundraisers are professionals, just like lawyers, doctors, accountants. It's a valuable profession. It's a profession that takes a lot of education, skill, and experience to be good in. So should we pay professional fundraisers? And I think the question is probably referring to external fundraisers outside our third parties, outside our organization. Yes, as long as we're comfortable with their ethics, that their approach mirrors the values of our organization, I don't see a negative legal implication to paying professional fundraisers. Can we pay them a percentage of what they bring in? That's the more problematic question. According to the ethical standards of the Association of Fundraising Professionals, AFP, it is unethical to pay a fundraiser based on a percentage of what they bring in. The reason being, when I as a donor make a gift to that fundraiser, it's my expectation that 100% of my gift is going in some way to benefit that organization. I haven't had that disclosure. I haven't had that transparency that a percentage of my gift is going to a paid fundraiser. There's a lot of court cases out there. There's a lot of legal cases out there where organizations have gotten themselves in trouble by paying based on a percentage of fees, a percentage of donations brought in. So two important question, but I would address it as two questions.
Okay. All right. Well, that I think wraps us up for today. I do want to remind everyone we'll be circulating the recording. And in fact, since you've attended this, we will at some point in the next few weeks send you the recordings of every webinar in this series. So you'll have plenty of information to digest over the long, cold winter.
Michelle, I'd like to just say goodbye to everybody and thank everybody for what you're doing out in your communities. This is an extremely difficult time to be a nonprofit leader. I have a tremendous amount of respect for what you all are doing on a daily basis. Stay safe, stay well, and thank you for attending.
Thanks, everyone.
Gregory, it's Rebecca. Would
Yes,
you like me to email you so that we can chat real quickly about this other situation, or?
Absolutely. If you can
Okay.
email me, that would be extremely helpful.
I will do that. Thank you so much. It really was a great seminar. Appreciate it.
Thank you. I appreciate it. It's nice meeting you.